Selling put options is a relatively simple options trading strategy that can yield attractive results. The strategy has a high probability of success in rising, neutral, and even slowly declining markets. In this video, I'm going to cover everything you need to know about selling put options for monthly income, including specific examples, how to reduce the risk of the strategy, and a put selling study in Amazon from 2023 to showcase the strategy's potential. If at any point in these sections you feel like you've got these concepts down or you're already familiar with them, feel free to skip ahead using the chapters below. First, let's cover the basics of put options just in case you don't understand what they are. Put options are financial contracts that give the buyer the ability to sell 100 shares of stock at a fixed price before a specified date. So when you buy a put option, you get this ability to sell shares of stock at this fixed strike price. And this value is going to increase as the stock price goes down. So when you're buying a put option, you are essentially buying an insurance contract against a stock's price decrease. As the stock price decreases, the put's value will increase because the value of selling shares at this fixed price, which is called the strike price, increases as the share price gets lower and lower. This is just a simple graph to demonstrate that when a stock's price goes down, we can see that the put's price goes up. So on the top half of the chart, we're looking at Tesla's stock price. And on the bottom part of this chart, we are looking at a specific option on Tesla, specifically a put option. We can see that the stock price in this example falls 23% and the option price increases by 100%. And this is just demonstrating that put option prices go up when the stock price falls, and this generates gains for the option buyer. However, if the stock price remains above the put strike price as time passes, the put's value will trend to zero by its expiration date. And at expiration, there's no more time left for the stock to fall and increase the put's value. And since there's no value in selling shares at the strike price here, which is lower than the current stock price, this put option will expire worthless. So the insurance contract essentially expires worthless because the disaster scenario did not happen. And this means that the put's price will decrease. And for every option buyer, there is an option seller. And this means whoever sells the put option, if the stock price remains above its strike price over time, this put option will decrease and the put seller will profit by the amount that they sold that put option for. So just as a quick recap, when you're buying puts, that is a bearish strategy. You're going to make money when the stock price falls. And when you're shorting or selling puts, that means you are implementing a bullish strategy, which will make money as the stock price increases. In the context of selling or shorting puts, we actually only need the stock price to stay above that strike price as time passes. In this first example, let's say we have an investor who is bullish on Amazon, but doesn't want to pay for 100 shares of stock because that's pretty expensive. So instead, they are going to sell a put option to gain exposure to an increase in Amazon stock price, but they can make a really solid return on their money with a far less amount of money as compared to buying 100 shares of stock. In this example, Amazon is starting at $85 per share, and this investor sells an 80 strike put in Amazon. The price that they sell this option for is $3.55. And when we're talking about options, we have to multiply the price by 100 since every option can buy or sell 100 shares of stock. And when we multiply the price by 100, we get $355. And if we sell this put option, that means we collect $355 into our accounts. So on this next slide, we're looking at a chart of Amazon stock price relative to the strike price of the put. And in the bottom half of this graph, we're looking at the profit and loss of this position, which is selling the 80 put. As mentioned, a short put will profit so long as the stock price remains above the strike price, which in this case is $80 over time. The max profit occurs if the stock price is above the strike price at expiration. Once this option is closed or allowed to expire worthless, then the investor can continue selling put options and potentially make more and more money every single month. One thing that I want to mention here is that you can close your short put position at any time, and it is wise to do so if you get a significant portion of your max profit early in the trade. And as we can see in this trade, we saw a profit of over $250, which is 71% of the profit potential very early in this trade as Amazon shares went higher. So since I shorted this put for a total value of $355, that is the max profit potential. And so if it goes up to a profit of $250 within the first 2 weeks of the trade, we can see there's still, 33 to 30 days left until expiration, but there's only another $100 that we can make. And so in this example, a trader could have bought back the put for $100, let's say, and secured their gain of $255. So that's how the profit and loss works when you're selling or shorting any option. If the price falls from your initial sale price, you can buy back the option, paying less than you initially received, and you're left with your profit. But as I mentioned earlier, if a stock's price falls, especially really significantly, then put prices on that stock will increase. And if we short a put option and the stock price plummets and the put value that we sold surges, we are going to have losses on our position. In this example, we are looking at Apple, and we are shorting the 185 put in this specific example. The sale price of this put initially was $1.90, which means we would collect $190 into our account for selling this put option. But as we can see, the stock price plummeted and the put position lost value. But if we were to compare that to buying 100 shares of Apple stock at the beginning, we would not have lost as much money. So the stock price at the end of this period was $171.21, and the ending put price was $13.79. So this would represent a value of $1,379. And since we shorted this put initially for $190 and the put value rose to a total value of $1,379, we are left with a loss of right around $1,200 on this short put position. Like any option strategy, selling put options has risk, and that is going to happen if the stock price collapses. Now, in this particular trade, there are two choices at the time of expiration. The trader can buy back the put for $13.79 and lock in that loss, or the trader can hold the put option through expiration and take assignment of 100 shares of stock at the strike price, which is $185. When it comes to options, there are two terms called exercise and assignment. If you own an option, you have the ability to exercise the option, which simply means to convert that option into a stock position at the option's strike price. In the case of put options, if you exercise a put option that you own, you are choosing to sell or short 100 shares of stock at the put option's strike price. In this case, if we buy the 185 put and decide to exercise that 185 put, we will effectively convert our 185 put into negative 100 shares, or we will sell 100 shares at the strike price of 185. But there is a seller for every option buyer. In this example, if we short the 185 put and we get assigned on this 185 put, then we will have to buy 100 shares of stock at the strike price of 185. So here's a very simple representation of what would happen. And our original position is shorting the 185 put, and if we get assigned on this put option, we will buy 100 shares of stock at 185 per share. I want to note that your risk remains the same before and after assignment. So when you short a put option, your max loss occurs if the stock price goes to zero. And if you buy 100 shares of stock, you're going to have the same max loss potential. If the stock price goes to zero, you're going to lose $185 per share times $100, which is going to be a loss of $18,500. And the same would be true if you were to short a put option. But fortunately, the stock price going to zero is really, really unlikely. But for all intents and purposes of this video, when you're selling put options, that is the worst case scenario, is to see the stock price go to zero, because then the put option will essentially be worth its strike price, which is going to be worth a lot more than you sold it for, and therefore you're going to have big losses on that position. While it is unlikely to be assigned on an option before expiration, especially if there's a couple weeks left until expiration, if you hold an in-the-money option through expiration, you will automatically be assigned on that option. So any options held through expiration that are in the money by 1 penny or more are automatically exercised and assigned. A put option being in the money simply means that the stock price is at least 1 penny below the strike price. So for example, if we short the 185 put, if the stock is at $184.99 or lower and you hold the put through expiration, you will be assigned on that put option and effectively buy 100 shares of stock at the strike price of 185. The reason I'm telling you this is because if you do sell an option and it becomes in the money well before expiration, you can avoid the assignment process by buying back that option and locking in the loss and then moving on to the next trade. Due to the high cost of buying 100 shares at the put strike price and just simply the high risk nature of selling a put option and seeing the stock price collapse, selling put options can require a high margin requirement, which is simply the amount of money that you need to enter the trade. For example, I just pulled up an Amazon option to see the margin requirement, and I went to the 125 strike price with 44 days to expiration. This puts price was $2.05, which gives us a maximum profit potential of $205. The margin requirement to enter this position was $1,669. And if we run the numbers here, if we have a $205 maximum profit potential and we have a margin requirement of $1,669, this gives us a maximum return on capital of a positive 12% in 44 days. So while there is a high margin requirement for selling put options, the return on that margin requirement can be really substantial, especially when we consider that this is over a 44-day period. To showcase the potential performance of selling put options for monthly income, I wanted to run a quick study. So I went to Amazon and ran a monthly short put strategy from January 2023 until the present date, which is the beginning of November. What I did was start on the first trading day of January, and I went to the February monthly expiration cycle. And then from then on the day of expiration, I went to the following monthly expiration cycle, which had about 30 days until expiration. And I chose a put strike that was 5% below Amazon's stock price. And I just repeated that strategy from January until present. And here's a final graph visualizing the entire strategy. So on the top half here, we have the Amazon stock price versus the put strike prices that were used in this study. So we can see that we started here, and as Amazon stock price went higher, the put strike stair-stepped higher with the stock price. When the strike price changes, that is essentially expiration. So as long as the stock price is above this yellow line when it gaps up, that means that it expired worthless and had the maximum profit potential. As we can see here, this was the losing trade because Amazon stock price fell well below this yellow line, which was the strike price used for this trade. On the bottom half of this graph, we have the cumulative P&L of this short put strategy in Amazon. And as we can see, for almost the entire year, this strategy was consistently making money month in, month out, showcasing that selling puts can be a viable monthly income strategy. Unfortunately, we did have this one big loss, but we'll talk about later how we could have avoided that or how we could be more cautious in the future and lose less money on those losing trades. But overall, this was a very successful test. And this showcases that if you have a stock that is in a upward trend and you're selling put options month in and month out, you can see very steady profits over time. Here is the monthly P&L table showing the month of entry and all the P&Ls, the estimated margin requirement, and then the return on capital for all of these trades. As we've already gone over, every single trade was profitable except for the September entry, and the cumulative P&L came out to a positive $1,473. Now I want to talk about how you can reduce the risk when selling put options as a monthly strategy. The first and easiest way to reduce the risk when selling puts is to instead sell put spreads, which are called put credit spreads. A put credit spread is the combination of a short put, which is the strategy we've already talked about, but we're going to combine that with a long put at a lower strike price. So we're going to short a put at this strike price, and then to limit the losses on the strategy, we buy another put at a lower strike price, and this gives us a trade with limited loss potential and far less loss potential than selling put options all by themselves. Here are two risk graphs that I created. This is a short put risk graph, which shows a hypothetical short 240 strike put with 60 days to expiration, and the stock price is at $250 at the time of entry. We can see that, as we've already discussed, we have profit potential if the stock price at least remains above the strike price over time, but if the stock price plummets, we have a lot of loss potential on the downside. On the right-hand side, we're looking at the short 240 put in addition to buying the 230 put. So as we can see here, we're looking at essentially the same strategy, except we're limiting the risk by buying that 230 strike put. And again, the stock price is starting at 250. But the big difference here is if we go to the downside, we can see that this strategy has a maximum loss potential of around $750, whereas this short 240 put has loss potential that far exceeds $750. What you're going to give up, though, is you're going to give up some profit potential. So if we look at the max profit of the 240 put by itself, this put option can make around $500 at expiration. And if we look at the put spread, we see that the max profit potential is right around $250. However, I will mention that the put spread will have a far lower margin requirement as compared to selling the put option. And that's because the put spread, since it has a max loss potential of $750, the margin requirement for this position would be $750. Whereas the margin requirement for this position, which is the short 240 put all by itself, this margin requirement would probably be $4,000 or $5,000. So if we were to actually match the margin requirements, we would actually have far more profit potential with the put spread, which you could argue is a case for selling put spreads as opposed to selling puts by themselves. The second way to reduce the risk of selling put options is to be cautious after big stock market increases. Here's a chart of Amazon from 2023 until present. And as we can see, over this test period that we just looked at, Amazon's stock price was on an absolute tear. Now, the big loss that we saw, which was selling the 135 put in September, this position lost $770 because we sold a put literally right here. So Amazon had a huge price movement higher, and we sold a put option in that test with a strike price of 135 right at the top of this rally. And then the stock price fell off a cliff. And obviously that's not a good thing to see when you are shorting put options. And if we zoom out a little bit to the weekly time frame, we can get even more confirmation that that was a risky time to sell puts in Amazon, because we saw historically, we did see a big sell-off in Amazon at around the 140 price level, and the stock price went all the way down to $70. And if you believe in technical analysis and you look at support and resistance zones, this obviously would have been a very risky spot to short put options as the stock price was coming into a zone of resistance. The third way to reduce risk when selling put options is to wait for high implied volatility, because high implied volatility means you are selling more expensive options. Also, when you have high implied volatility, since option prices are broadly more expensive, this means you will be able to sell a put option with a strike price that is further below the stock price to collect the same amount of premium as a lower implied volatility environment with a higher strike price. And I'll give you an example of exactly what that means. Here is a table of simulated put prices, and we're assuming a stock is at $150, and we are looking at options with 60 days to expiration. And these are the simulated 140 strike put prices at various levels of implied volatility. With implied volatility at 15%, we get an estimated option price of 42 cents. And when we stair step all the way higher, if we go to an implied volatility environment of 30%, this 140 strike put option is now estimated to be $2.79. And so there's a huge difference of selling a put option that is $10 below the stock price when we have a 15% implied volatility versus a 30% implied volatility. And just to give you an example of what I was talking about earlier, if we have an implied volatility environment of 15% and the 140 strike put is 42 cents, if we are instead in a 25 or 30% implied volatility environment, the put option that is going to be 42 cents is going to have a strike price that is well below 140. For example, it might be 130 or 125. I'm not exactly sure. But to collect the same amount of premium as this 15% implied volatility environment, when we are in a higher implied volatility environment, you can go to a much lower strike price to collect the same amount of premium. Implied volatility is a measurement of option prices, and basically what that means is that when implied volatility is really high, that is just telling us that option prices are really juicy and they're more expensive as compared to when implied volatility is low. Implied volatility, quite literally, is basically the stock market or a specific stock's expected future volatility as suggested by the option prices. So when option prices are really expensive, that means there's a lot of demand for buying options, whether it's for speculation or for hedging purposes. And when the options are really expensive, that just means that the market is pricing in a lot of expected volatility going forward. And when option prices are really cheap, that means options markets are pricing in less volatility for that stock going forward. The VIX index specifically measures 30-day option prices on the S&P 500 index, but it is also a good gauge for market-wide implied volatility or option price expensiveness. If we go back to earlier this year in 2023, we can see the VIX index was around 30, and this is indicative of high option prices, or higher option prices, I should say, as compared to this lower point in time when the VIX index was in the low teens. High implied volatility typically coincides with big downside movements in a specific stock or market. And the benefits of selling put options when implied volatility is high is number one, that means we are typically selling puts into a downside movement. And so if you're doing so and expecting a bounce in the stock price, then that gives you a potentially really good entry point. But it could also work against you if you sell the put options too soon and the stock price keeps declining, then obviously that gives you a lot of exposure to the downside when you're selling put options. Number two is that you can sell further out of the money strike prices, as I mentioned briefly before. So when option prices are more expensive, implied volatility is high. Since the market is expecting a lot of volatility from the stock going forward, this allows us to sell a put option further below the strike price as compared to when implied volatility is low and we have to sell options with strike prices much closer to the stock price to collect decent amounts of premium. The third benefit, and perhaps the biggest benefit of selling put options when implied volatility is high into a downside movement, is that a subsequent rally in the stock price will crush the put option price from the combination of the stock price increase and the implied volatility decrease. So generally speaking, if a stock price increases, put option prices will go down without any change in time and without any change in implied volatility. However, when we have an increase in the stock price, we typically will see a decrease in implied volatility, especially for put options. And that just means that as the stock price is rising, we see less demand for downside protection in the form of put buying. And the combination of these two things will decimate a put options price. We saw a really good example of this in July 2023 when Amazon's stock price went from below $130 to $142. And this short put positions P&L went from 0 to basically 100% of the maximum profit potential. And that's because this put price essentially went to 0 in just a couple of days from the combination of the stock price going up and implied volatility dropping off a cliff. I'm only going to show the cumulative performance here, but if you want to see graphs of each individual trade's performance, please check the link in the description below where you can download an entire PDF of this presentation, in addition to getting my options trading for beginners PDF, which is over 170 pages long, covering the core concepts that you need to understand as a beginner, in addition to a library of the popular strategies, how they work and how they're set up, with specific examples of when they made and lost money. If you love the analysis in this video and you want more content just like this, check the link in the description below for data-driven option strategies. I've been spending countless hours doing the research and creating the content for this course, and I'm really happy with how it's coming together, and the response has been overwhelmingly positive.